Good weekend, all. Ira Epstein of Linn Associates with your weekend edition of your agriculture update, and this is for Friday. We're now at the 29th of March, 2019, just after 2:20 in the afternoon, and look at the size of the declines in some of the grains. Corn's generally not the wildest market. Boy, did it get smashed today, and I'll show you why in a moment here. I had warned traders here that we had on Friday at 11 in the morning coming the USDA supply-demand report, and we were also getting acreage numbers. And getting the first acreage numbers, that's what set this market off. Let's go to those for a moment. Quarterly grain stocks, let's start with those. Nothing big here, 86.05 versus an 8.34 billion, a bearish tinge to it. Soybeans, 2715 versus a 268, a slight bearish tinge to it. And wheat stocks, 1591 versus 1656 billion, bearish tinge to it. Now let's go to the prospective plantings, because that is where I think the bearishness hits. In the corn, you got 92.792 million acres versus an estimated 9133 acres. Way more also than in 2018. In soybeans, 84.6717 million acres, down about 1.5 million acres from the estimate, and way down from last year's 89 million acres. Then the wheat. We pick up in the wheat to 47.339 versus a 46.92 estimate, and last year about similar to it, not too far away from where you were. And in cotton, a friendly number, 13.78 million acres versus the estimated 14.5, and still under where you were in 2018. So those numbers came together, and they definitely caused havoc in a market that normally doesn't see a lot on an acreage report. When we look at soybeans on a monthly chart, excuse me, I have terrible allergies hitting me today. The market made a run-up, and that run-up, now the question is, was that about it? It never was able to get back over the 18-month moving average of closes, which is 933 3/4. Where the market is having great difficulty is in the retracement level on Fibonacci. If you look, we went up to 1071 last year in the April time frame, right in that zone. Came down in July to 810.5. We had a bounce, and each one of these lines represent from top to bottom retracement levels. So you've got your retracement here of 38, 50, and 62%, and you can see what's going on. It's this first retracement that the market is stalled out against. When we now look at the swing line study on the chart, excuse me, lower highs, lower lows. Bearish unless you get back over 912, and that would break this trend. Where's the market been playing? Look at the 18-week average of closes. You settled back under it. You were over it last week. Now you're back under it. Will you get follow-through through the last low, or are you going to break through that 912 area? That's probably what the bears are asking. But they're in control because the market is under the 18-week average. You're putting into play 877 3/4. The lower Bollinger Band is a potential area where I would expect to see some short covering, and momentum continues to point down. So I'm going to view this as the bears have total control. In the meal market, you've literally gone from the lower Bollinger Band and in 2 weeks to the upper band and right back to the 18-day average of closes. Number one, I don't see a trend. I see a lower low and a higher high caught in those numbers, and I see momentum pretty flat. In soybean oil, I see a downtrend. You have the pattern of lower highs, lower lows, under the 18-week average of closes. So I would be looking for bears to defend their position in the 2904 zone. Even if the market got up and rallied to 2978, you could not get a bullish setup. What you would have is a lower low and a higher high. So I think the bears, because you're also under that 18-day average, momentum pointing down, in control. In the corn market today, they just took this thing down hard. Last week you were up at a high of 380 3/4. This week 24 cents lower at 356. Now if you look at the close, it was 356.5, and if you look at the lower Bollinger Band, it's around 357 3/4. You're right in that zone where the market's trying to grab hold. The 100-week average in green had no impact on the market today, and that's not totally unexpected. When you get an acreage number or a report that the market is not expecting, you've got to be careful. That's what reports are about. Reports in the fundamental sense verify or change the fundamentals of a market. Chart action is in response to that coming out at that point in time. Prior to that, the market is working on general thoughts, what the market might do, blah, blah, blah. Well, now the market has changed itself. So you have the pattern of lower highs, you've had lower lows, you're in a downtrend, but I am going to say you've hit a downside target. In the wheat market, the 100-week average is acting as the resistance. You saw how it rallied up to it this week, stalled out there. Now you've got an outside week down, I believe. Last week's low was 453 3/4. Yep, you took that out and the high out. To know that wheat's got more upside, I need to take out this week's high next week or the week after. Barring that, I will look at the market as having lower highs, lower lows in a downtrend with the potential for 440 1/4, the lower Bollinger Band, to come into play. Take this high out of this week, and then coming into play could be the 18-week average at 498 1/4. In the cocoa market, this is just churning sideways action. It is a market with lower highs, but now higher lows. Do you see that? I'm going to call the market trendless. The bias is up because you finished the week out over the 18-week average. The momentum's up, but the swing line is down, basically. Difficult market. The sugar market's ready for a move. The question is, which is the way? If it takes out the 1287 level, you put into play probably the 100-week average and certainly the upper Bollinger Band if it makes a run through that. If the market takes out this week's low, you're putting into play the 1197. Momentum is flat. The trend is down. Lower highs, lower lows. The settlement was under the 18-week average. But because of where you're at, if you take out that 1287, you can actually turn the trend with higher lows, higher highs, and get a breakout to the upside. However, that breakout has got two big resistance areas in front of it. In the coffee market, momentum is still pointing down. Open interest in coffee, which means the coming together of a long and a short to create a futures contract, has been exploding. So obviously, when you get that happening, people think something's going to give here. Now, coffee's been down at this price for quite a while if you take a look at it. In order to keep things going, it needs some new, fresh, bare news. Support's right on the market, right under it at 91.81. A warning sign, in my opinion, would be taking out the 96.80 level. It would not necessarily be bullish, but it would end this bear phase. That much I would say. And that could put into play back to the 99.60 level, and given the record size open interest, who knows what happens from there. But who has control right now? The bears. Lower highs, lower lows, momentum down, bias down. Next target, if they can press it, 91.81, the lower Bollinger Band. The cotton, as I showed you, had bullish acreage, and that acreage kicked the market back up today right into the 100-day average where it stalled out. Now, remember, I don't use on slow stochastics on a weekly chart overbought or oversold. I just look at the momentum. I have found that that works way better. Momentum up, bias up. You've hit the first upside target. If it can move from here, well, then you've got the 79.62 level as resistance, support back at 74.45. In the cattle market, you broke down enough now to take out this prior low. So you got a higher high, a lower low, support coming in, and you've lost the upside momentum. The question is, does the 18-week moving average of closes hold the market, or is it going to make a run for the combination of the Bollinger Band and the 100-day average? What about turning a trend up? Can't do it in this formation next week. Even if you took out the last week's high, it won't do it. In the hog market, I'd be watching this market carefully. It's lost the embedded reading on the daily charts, which often leads to price, excuse me, and the 18-day average coming together. It's trying to break back right now. You're over the upper Bollinger Band, and this is 2 weeks in a row, actually 3 weeks in a row. So I give the market next week a 2% chance of staying over that number. Is that bearish? No. You've broken out of the sideways action. You've established you're going to trade higher. The question is it ready for a correction? You know, one of the things that I like to do, and let me get this to right here. I know I have it. There we go. One of the things I start you off in the morning with are my morning subscriber videos. And let me explain what they are. In these videos that you're watching when my voice is normal, I got exuberance and all, but I don't say buy here, sell there. In these videos in the morning, which my subscriber, I throw trade ideas galore at you. And when you see why, I explain the idea. I give you where I think you should enter, the risk on the trade, where you should come out. Some are day trades. I show different techniques than you're seeing here, I promise that. And I cover all these markets in the same sequence every time. The reason, maybe you just want to look at energies. Well, why are you looking then at stock indices and so on? You can just grab the recorder, move to where you want to go, and all the information you want is there. I'm going to describe the chart action. I'm going to tell you, as somebody in this game 50 years, what I think other pros are doing in the market. I'm going to explain the technicals and the fundamentals to you. And I'm going to throw out trade ideas galore. Now, the biggest problem you probably have is what I went through. You want to make a trade, you wish you could talk to somebody, they're not around, there's no sounding board. I want to be that sounding board. So in doing so, I make it pretty inexpensive. 26 cents a day. $7.95 for 30 days, and then you decide. You can sign up for a one-year subscription. You can go to a monthly. That's your call. There is no contract. You decide what you want to do. But you owe it to yourself to give it a try, at least see what I'm talking about, because I can't show samples here. It's got to be behind a user ID and password according to the government. So to get it, either call my staff. Better yet, just go to our website under education or research. Just go to Ira's morning subscriber video. It's all explained. You decide what you want to do. I'm Ira Epstein. Have a good day.